What is going on, guys? What is going on, guys? First order of business. First order of business. Let us hit that thumbs up. Hit that thumbs up so that other people can find this. Because I think the way that the YouTube algorithm works with lives is that if you hit that thumbs up, more people will find the stream. So do that. All right. Uh, Obviously, you're here because of the FOMC meeting. You're not here because of me. You're here because you want to see what Jerome Powell has to say. So we're going to talk about, we'll look at charts. I'm going to talk about what are potential decisions that Jerome Powell can make in today's meeting, and what will we want him to be focusing on in terms of his language, because I think that the rate hikes for the most part are priced in, although there is a chance that he could surprise with a 50. I think that it is most likely to be 25 basis points. Most of the market thinks this too. There's a 99.3 chance that it is going to be 25 basis points. There's even a 0.7% chance that it's going to be zero, but there is no percent chance that it's going to be 50. However, I do think that he could potentially surprise with a 50, and we'll talk about why that is in a second. Alejandro donated $5. Thank you so much, man. Yeah, just remember that all of our live streams here, all of our live streams are St. Jude's fundraisers. So instead of hitting super chat, be sure to hit that donate button. Make the kids at St. Jude just that much happier and give them a little bit more hope. All right. So wait, can you guys hear me? Let me know if you can hear me. What's going on? H Cupcake, Henry, Exhumed, Queasy Boy or Squeeze Boy, however the hell you say that. Lewis Silas, what's going on, man? Beto, what's going on, man? Hey, I wanted to ask you something, Beto. I'll ask you off stream. I wanted to ask you about a certain place in Mexico that I've never been to that I'm actually going to be going to this week. But I'll ask you off stream. Shafiq, what's going on, man? Noor, Miguel Garcia, what's going on? Cool. Is the stream, does it look smooth and how you guys expect it to look? Hey, what's going on, Dr. Jennifer Barry? How you doing? Jay Fine, Jed Goski, Frankie, Farouk, Pharma, Albo, Portito, Adrian, what's going on? All right. So, you know that at 2 p.m. Eastern, so in about 25 minutes, we're going to be getting the Fed interest rate hike decision. And then at 2:30 p.m. is Papa J. Powell's speech, right? As of right now, the S&P 500 is down 0.37%. If we look at the NASDAQ, is the NASDAQ up? Okay, it's flat, negative 0.01%. Is that true? Hold on. Last time I looked, it was down by a lot more. Oh, no. Okay. Sorry. NASDAQ is down 0.24%. S&P down similarly. What I was saying on Twitter was don't be surprised if the market actually rips on bad news. Remember, the market is really a vehicle for liquidity for institutions. And we've seen this before. If you guys remember this here, this candle here, this wick where we first broke out of this downtrend line, this was on FOMC day, right? December 13th, or was that on CPI day? I can't remember. Remember there was back-to-back CPI and FOMC was December 13th and December 14th. But either way, the market actually faked out and ripped super high, breaking out of this trend line, sucking in all of this liquidity to then go short. So even though we popped comfortably out of this trend line, don't be surprised if the market rips on bad news to draw in more liquidity. I went over the history of breaking this type of trend line before, and most times the market has actually gone on to form all-time highs again, right? But we have had 3 times in history. It was 2002, 2008, and 1940, where we broke out of this trend line and we actually crashed back down. And obviously, those were times during recessions. Now, whether we're in a recession or not, we're not going to know until after the recession. That's the odd part about it, is that the national economic, what is it? NEB. Oh my God, why am I blanking on this? Oh, hold on. It's gonna kill me if I don't get this. What are they called? Bureau of National Bureau of Economic Research, NBER. They don't usually declare a recession until I think 18 months after the recession has already started. So, on average, so don't expect there to be a warning that we're already in a recession. Usually we won't know until after the fact. But all is going to hinge today on Jerome Powell. So what we're expecting is, as I said, a 25 basis point rate hike, right? That's expected. However, what we don't know is what they're going to be saying about this. This right here, the financial conditions, it's the easiest in 11 months. And the way they determine this is it's basically a Z-score based on equity markets and bond markets, right? So obviously, this right here, the fact that we're at an easier financial condition than before the Fed even started hiking rates is super alarming here. This is very alarming, right? We're at a higher score on this matrix, which measures how easy the financial conditions are. And we're at a higher rate than before the Fed even started hiking. So if you look at the markets and you look at, say, like the price of, let's look at the price of lumber, right? The price of lumber is up in the last, and this would have been an awesome futures play, even though for me, I don't track this enough to know how this market moves. But just in the last 3.5 weeks, lumber's up. The price of lumber's up 45%, right? If you look at a high beta ETF, so if you look at the S&P 500 high beta, we are back at highs, and these are the highs that we were at right around the Jackson Hole meeting. And this is when, if you remember, Jerome Powell actually put the smackdown on any sort of talk of easing or, any dovish talk, because at that point, inflation was showing a peaking signal. It wasn't declining yet at this point, but it was showing that it was peaking. So there was a lot of enthusiasm in the market, and these high beta stocks, which really is just a fancy term for meaning stocks that are volatile and risky. Usually a lot of high growth stocks are in these ETFs. This is when Jerome Powell came out super hawkish, and the market, as well as the high risk stocks, tanked. Well, we're back at these levels now. So we have high beta, price of lumber. There's so much liquidity in the markets and a lot of enthusiasm because there is this feeling that the Fed's job is almost finished. And there, even the bonds market, the bond market is not even believing Jerome Powell or the Fed at this point, because the bond market is pricing in and betting that the Fed funds rate doesn't even hit 5% this year, where the Federal Reserve kept saying and continues to say that rates will be higher than 5% for longer. So there's a huge disconnect here. Now, I do think a pause is more imminent than most people think. And it is because if you look at the bond market, the 2-year Treasury is now below the Fed funds rate. And in history, when that happens, look at this here, look at this here, let me just go back a little bit and show you how this reacts. So 2000, 2008, and then now, right? This doesn't happen without the Fed actually pausing, because the Fed cannot sustain or cannot take the 2-year Treasury being above the Fed funds rate. See, for newbies to understand this, the Fed funds rate is basically the overnight rate. It's the rate at which banks lend each other money, right? If the 2-year treasury is below the Fed funds rate, then that is going to disrupt the treasury market, because what incentive would banks have to buy 2-year treasuries if they can get a better rate overnight? Imagine how crazy that is. Imagine that that instead of buying a 2-year treasury and getting that yield, you can actually get that yield basically overnight. So that causes disruptions in the treasury market, which our entire financial system in the US unfortunately is based upon, right? We don't have a gold standard anymore. Dollars are backed by treasuries, and the way that the US government raises money is by selling more treasuries. And if the overnight rate is above the 2-year treasury rate, then there will be no incentive to buy 2-year treasuries. So this is why you see the Fed pausing every single time that this happens. So I do think we are near a pause. I don't think that, well, we'll talk about the language in a second. Any questions so far? Any questions so far? And by the way, guys, hit that thumbs up right now. Anyone that's watching this, hit that thumbs up so that more people find this. And more, we can get some quality information out, as well as obviously more donations to St. Jude's. Thank you, Anonymous, donating $5. Thank you, another Anonymous, donating $20. You guys are lighting up the donations today. Appreciate you guys. And obviously, Alejandro, thank you so much for your donation as well. So hit that thumbs up. Please be 50 so I can ride the market down in my inverse call options. Yeah, Jay, I do think there's danger here that I see a lot of. It scares me when everybody is bearish and when everybody has loaded up on puts, because I don't think people understand the concept of liquidity. And I think that a lot of people have been burned and are going to get burned here. Now, I have short positions mostly maintained as hedges. So if you ask me honestly, if you hook me up to a lie detector test, and you ask me, would I rather have the market go up, or would I rather have the market go down? I would much rather have the market go up, right? Like I have too many long positions over the years to want the market to go down. I actually want the market to go up, and I wish all of my hedges go to zero, like, if I'm being honest. Oh wow, look at that. Is it on this side or this side? The green screen. I need to fix the green screen. Jose Soto, thank you so much for donating $50, man. Appreciate it. That's a huge donation. Thank you so much. Much appreciated. But I would much rather have, honestly, the market go up as opposed to down. So, I do think that too many people have hedged short or have taken huge short positions without actually having any long positions. And I don't think, honestly, that in this case here, I don't think that is the way to go. Now, maybe, in January when we were riding this trend down, inflation, wasn't showing a sign of slowing down, etc. It was bad news after bad news. I don't mind, being in cash and taking short positions here, but the fact that we continue to test this trend line and now we broke out of it, we had this huge inverse head and shoulders, which is a very bullish pattern. And the Fed is close to pausing, in my opinion. They're not close to cutting, but they are close to pausing. I think that taking out huge short positions here is actually very risky. And I think that taking long positions here is very risky, right? This is why on my Twitter, and by the way, follow me on Twitter for free daily finance content. The link is in the description. Follow me on Twitter and Instagram. I post daily trade ideas, analysis, finance, trading content, memes, etc. But this is why I said on my Twitter, what did I say? I said sitting out this week is the right move from a risk management perspective. You are not buying at a discount here. And if you're shorting, you have 3 events to dodge: FOMC earnings. We obviously have Alphabet, Amazon, and Apple earnings tomorrow, and unemployment on Friday, right? So, in this case, people that are longing from here, I think, are crazy. And people that are shorting from here, I think, need to watch out. You know, if you guys have been following this channel, you know that when the NASDAQ was down 37%, we started establishing positions in October. I didn't go in as heavy as I would like. I started a very nice size position then. I sent that out in the Discord, in the trade alerts. And you know, also selectively buying things like Tesla below 120, etc. But you know, I think that after this huge market rally, trying to long from here is crazy if that's your first position here. And I do think that shorting, I don't think that's crazy, but I do think that you have to watch out. And I see a lot of people shorting, thinking that, you know, it's whatever Jerome Powell is going to say today, it's going to be inevitable. And we'll talk about what Jerome Powell is going to say in a second. Do you day trade? You must not watch this channel, Wade Youngblood. You must not watch this channel. Shafiq, thank you so much, man. Donating $20 to St. Jude. Always generous of you, man. Thank you so much. All right. So what can Jerome Powell say here? Obviously, 25 basis points is priced in. Could he raise to 50? Yes. Looking at this, I think that and the Fed has talked about financial conditions index, maybe not specifically the Bloomberg one, but there are different financial conditions indexes showing how easy or how tight the conditions are, right? So I think if they bring this up and the fact that unemployment is still at 3.5%, obviously we have new unemployment numbers coming out Friday, but Jerome Powell supposedly doesn't have those numbers. If we think that, or if they focus on unemployment and they focus on financial conditions and they focus on, as I said, if you look at the high beta names specifically and how much liquidity there is in the market, the price of lumber, etc., then I do think that Jerome Powell can come in with 50 for sure, especially if it looks like the Fed rate hikes haven't been really having a detrimental effect on the market. Now, obviously, these things are lagging. To what extent are they lagging? Nobody knows. That's why they're called a blunt tool instrument, is because by the time that these things take effect, it's usually, you know, it usually comes crashing down all at once, right? You can't just keep ratcheting up the rate hiking dial and not see an effect in the economy. So the longer that it doesn't have a major effect, I think the harsher the effect will be once it actually hits the market. So I do think there's a chance that he could do 50 if he's looking at the right metrics. But, you know, could he be dovish? I don't think there's any. Here's my perspective, and you guys correct me if I'm wrong. Please put it in the chat, because I really want to hear from you, and we'll comment about it. But you know, from my perspective, I don't think there is really an upside to him being dovish. Okay, the market is doing really well, especially since the beginning of the year. It's only been going up since those October lows. High beta is high. Financial conditions are easing. I really don't think, like, if he pauses here, that's going to have or not pauses, but if he comes out dovish, that's going to have a detrimental effect on the market, I think. I'm sorry, that's going to have a euphoric effect on the market. And if we think about, what does the Fed want? Does the Fed want there to be hysteria? Does the Fed want there to be, you know, an upside to corporate earnings, for instance, an upside to employment? Does the Fed want a tight labor market? Or do they want to curb spending? Do they want to curb prices? Do they want to curb employment? Do they want to curb wages? Do they want to curb easing financial conditions? If the honest answer to that is yes, then I don't think there's any upside in him coming out and saying that, you know, coming out dovish. So there could be a best of both worlds scenario where he feels like he doesn't have to raise by 50 to shock and awe the market, where he could raise by 25 and then talk a lot of shit. Right? Raise by 25 and then talk tough, you know, like a bouncer at a seedy club, right? Coming out and talking tough, and hopefully you know, and seeing if the market reacts to that, and then if not, then maybe coming out with shock and awe in March before a pause. So I could easily see that being probably the likeliest scenario is raising by 25, but talking tough, right? Raising by 50, not impossible, by the way, regardless of what the hell this says. In my view, not impossible if you're looking at certain metrics. It would create a shock and awe to the market. I think for sure the market would absolutely tank today if he raised by 50. Not impossible, but not the likeliest scenario. And then the unlikeliest scenario, in my view, is no rate hikes and dovish tone, right? So in order, again, I think it's 25 basis points talking tough is the likeliest one. The next likeliest one to me is a 50 basis point shock and awe rate hike. The next likeliest one is 25 basis points, but being dovish. And the unlikeliest one to me is complete dovishness, which is no rate hikes and talks of pausing, right? So that is where I would rank them. And by the way, I do have a running bet with the Academy where I will be sending out. Oh, nice. Shout out to our super analyst, Kirsten, taking this trade. What was it? This was a futures trade. Entry 4,065, target 4,072, out at 4,072. The super dope. Very nice. And we have a bunch of analysts as well in the Academy that help us out, especially if I'm, doing live streams or whatnot. But even then, I mean, they're super traders in their own right. But I do have a running bet with the Academy that I will be buying somebody a trading monitor today of their choice. If the Fed doesn't do a 25 basis point rate hike. So any deviation from that, and for those of you on the live stream that are part of the Academy, you know this. I will be picking out a random person and buying them a trading monitor of their choice, as long as they're not an asshole and pick the Apple, whatever the Apple 5K monitor is. But yeah, if they don't do 25 basis points, I'm buying somebody a new monitor today. So, all right, let's see. So 7 minutes, guys, 7 minutes until the rate hike decision. Zomox, thank you so much for your $20 to St. Jude's. Appreciate you. We are back to 1970 fees dovish. Bryce says, yes, I appreciate it. Mary Lala, hi, my man. What's going on, Mary? I'm betting on 52. Not 52, but 50 also. Johnny Curry, thank you so much, brother. $10 to St. Jude's. Appreciate you. You guys are lighting this up today. Got a strangle open for this shit. Huang, careful with strangles, okay? Careful with strangles. So, if you look at the, let me see if I can. If we're looking at the S&P 500, for instance, let's look at what the expected move is. Because if you got a strangle for the Fed meeting, you have to make sure that it hits the expected move, or else your strangle means nothing, right? So I don't think that people understand. They think that strangle is a free lunch. It is not. If your strangle does not make the expected move, right? Look at the expected move here on the S&P 500. I'm looking at SPX. It's $48. If from here, the S&P 500 doesn't move by this much, you are going to lose on your strangle. And I don't even know when your expiration date is, but find out what the expected move for your expiration date is. If the S&P does not move by this much, either plus or minus, your strangle is worth nothing. Okay, so please watch out when trading strangles. Make sure you understand implied volatility, expected move, etc. Guidance on earnings has sucked, yet the market still goes up. Clown world we live in. Not really, Bryce. Not really. The market is forward looking. So guidance on earnings hasn't been as bad as people would guess to be in a recessionary year. That's why. Also, the financial conditions, as I laid out, are still easy, right? Like the Fed rate hikes still have not had the effect that they wanted. Unemployment is at an all-time low while prices are coming down. So people are, really caught up in this potential soft landing scenario. But guess what? If you guys follow me on Twitter, and again, follow me on Twitter, I have extremely hot takes. You would know that, check this out, just in case you needed a reminder to take everything with a grain of salt. Not comparing this to 2008, but if the recent stock market rally is mostly based on a soft landing, fantasy and not fundamentals, and stay alert. So I posted a bunch of articles from 2007. This is from, what is this? From the Reuters. U.S. economy on track for a soft landing. This was September 26, 2007, right? And it was saying that the Dallas Fed was saying that the market was on track for a soft landing. A trade group representing the nation's manufacturers on Tuesday predicted a soft landing for the U.S. economy in 2007, right? So the trade group was wrong. Guess who else was wrong? The Fed chairman himself at the time was Ben Bernanke. Fed chairman projects a soft landing for the U.S. economy. This was in 2007. It's so funny reading these back, and we know, for those of us who are old enough, know how crazy the 2008 financial crisis was. In my lifetime, I've never seen anything like it. I mean, I had friends that walked out on mortgages. I had friends that couldn't find jobs. It was really a hellish time. And this, thankfully, is nothing like the 2008 financial crisis. But, this is just a reminder to take everything with a grain of salt, including this fantasy of a soft landing that is, right now permeated in the market, right? And it is showing itself in the market with this recent rally here. All right, Michael Burry is ready. Michael Burry is not the end all be all. And just because, Michael Burry is bearish doesn't mean that you're going to see the bearish move now. Like, think about this scenario. Have you, for those of you that are ultra bearish, I know you want to see the stock market tank today, but have you thought of, say, this inverse head and shoulders play out? And this is one of the patterns that I outlined in my TA videos, that we can easily come up to this 4,300 level, right? We can come up to this level, especially if Apple, Amazon, and Alphabet don't report terrible earnings or guidance. We can certainly come up to 4,300. But what if, at later this year, which I think is inevitable, we will see a recession. What if at that point we start tanking? So Michael Burry is not the end all be all with regards to timing. I do think that he has obviously an amazing pulse on the market, but it doesn't mean that we're going to tank today, right? Hey Z, if he raises by 50, how about a Mac Studio display? I'll be sure, Richard, not to pick you, all right? I'm not sure if you're in the academy, but I'll be sure not to pick you for just suggesting the Mac Studio display. So ZN plays off of J Powell again. What do you mean, Sashin? ZN is the 10-year futures, is the 10-year Treasury futures. He is a shit talker. Yeah, but he can also be dovish. Okay. Let's see what's going on right now. Hold on. Ethan, what the fuck is going on? Ethan, I don't know what the fuck you're referring to. Here we go. CNBC.
Increases as appropriate, so that phrase that some thought might come out remains in. The Fed is still en route to a level it calls a sufficiently restrictive level of the funds rate. One little bit of dovish commentary here says inflation has eased somewhat. However, it says it still remains elevated. The Fed is signaling a new focus on the extent of rate increases and not necessarily the pace. So it says in determining what it now says is the extent of increases. That word had been pace previously, so it's not thinking about it going up by 25. It's thinking about how far it goes at this point. On the economy, it sees modest growth in spending and production. It says job gains have been robust. The unemployment rate is low. All language from the prior statement. The decision was unanimous, with the 4 new voters replacing the prior 4 who were out there. So, Kelly, back to you. Up a quarter. Still thinking about ongoing increases, still heading to a sufficiently restrictive level.
Any dissent, Steve? That's a pretty big deal that they left in the word ongoing. Wow.
Yeah, they left in ongoing means they have more to go. I guess that's pretty clear. And they're not backing off anyway, this idea of going to what they call a sufficiently restrictive level, which tells you that they don't feel like they're there yet.
Right. And as we can imagine, Steve, thank you. We'll come back to you in just a moment. Markets are reacting about as poorly as you might expect. Although we were all saying all week long, we're probably bracing for a hawkish surprise. You can see stocks taking a leg lower and bond yields perking up a bit. Let's bring back our panel along with Bob Bassani and Rick Santelli. Rick, I'll turn to you first. What are your thoughts?
Well, you know, we do see 2-year notes spike, but they're already coming back down. We saw 10 spike. They're coming back down a bit. And the Dow Jones Industrial Average drop, but it's coming back. There's a lot of mean reversion going on there. Listen, after listening to Steve's highlights of what the Fed has in the statement, it seems to me that the guardians of the U.S. economy, which is the Federal Reserve, aren't going to be happy till they give birth to a recession. We've seen economic contractions like PMIs, and I see sections of the economy slowing, but we have a strong labor market, and labor is a pain that the Fed doesn't want to occur. They want to induce weak labor pains, and to do that, they're going to keep higher for longer. So no matter how you slice this, I do believe that the markets are going to continue to look beyond the rhetoric, look beyond trying to give birth to a recession and the cleansing breath it may need for pricing after we've gone through COVID and all those issues. But in the end, it certainly seems to me like all the momentum in pricing has reversed, and the only thing left is for the Fed not to blink too early, because there is no good reason in their minds, in my opinion, that they should ease back. They should keep rates up. But I certainly don't believe that there's going to be a March increase. My personal feeling is that this is going to be it for now.
I don't know. They just said ongoing rate increases will still be. By the way, the Dow's down about 400 points right now. David Kelly, I should say Jim, actually, we promised to turn to you. What are your kind of knee-jerk reactions here? What jumps out to you?
Yeah, so look, I think that another hike in March is probably on order. I think it's going to be very important to hear what they say in the press conference, in the sense that wage inflation, the tightness in the labor market, I think is what's concerning them the most. It's service sector inflation, and one of the biggest feed-ins to higher prices in wages, obviously, clearly is the tightness in the labor market. So this needs to be addressed. And I think the way the Fed is reading this is they're saying,
guys, it's right here, 25 basis points. Some people are projecting 75 and 50. Guys, they already announced it, 25 basis points.
To avoid is a type 2 error where they don't do enough right now when they've got inflation on the run, and then all of a sudden inflation starts to resurge again later this year, and then they have to restart their cycle, and that hurts markets more.
I'm going to go to Bob now, and then I'm going to come back to you, David Kelly, and remind David of something he said that has stuck in my head since before this rate tightening cycle began. But Bob, we were at 300 points down on the Dow as we headed into this result. Right now, we are down 367. How are stocks reacting? It would seem sort of they got what they expected.
Yeah, ongoing increase is appropriate. I think doesn't surprise anybody down here. The big debate right now, and you see that the S&P's lost about 5 points, 6 points maybe since this started. But the debate here is just how much more hawkish can Powell possibly sound? He's made it pretty clear where he stands on this. They're going to keep raising rates. They're going to keep them higher for longer. The market thinks they've got 1, maybe 2 small rate increases, and then they're going to cut rates by the end of the year. Fed futures are 4.5%. Not at 5 or 5 1/8. So who's right? The Fed apologists constantly say, don't fight the Fed. But I talk to bond market people. They've got their own cliches out there. And one of the ones I hear from the bond market guys is the Federal Reserve tells the market when it's going to raise rates, but the market tells the Fed when it's going to cut rates. And right now, the bet is exactly what David said, that the Fed is going to introduce some kind of recession that's going to force them to acknowledge that and cut rates later in the year. That's what the bond market says. And FOMC is 12 people, but the bond market is more than 12 million people. And that's one of the reasons I tend to spend a lot of time talking to the bond market guys at this point. So you see the dollar up right here and pretty modest reaction on the S&P.
David, before this whole rate tightening cycle began, I remember you specifically saying that traditionally...
All right, so 25 basis points is not bullish or bearish. It was expected. Yeah, I mean, obviously it was expected, 99.3%, as you see here. But that's not what we're listening for. We're listening for commentary from Jay Powell. And I think what you're going to get is a hawkish Jay Powell coming in, you know, in rap battle form, looking to take out all of the liquidity in the markets, especially since financial conditions are easing. And as someone said before in the chat, I do think that he will focus on the labor market. We do have unemployment coming out Friday. We have Apple, Amazon earnings and guidance tomorrow. Huge week in the market. So, you know, we'll see what happens. But I think Jerome Powell is going to come out and say there is no sign of tightening. There's no sign of pausing, even though I think it was Rick Santelli you heard there on CNBC talking about, or was it Steve Leisman? No, it wasn't Steve Leisman. It might have been Santelli, but he was saying that, you know, he personally thinks that that's it for this year in terms of rate hikes. I personally think that they are closer to pausing than not. Let's check out what's in the Fed statement, and then we will talk about, or we will hopefully tune into Jerome Powell and see. Let me see if they publish this video. Oh yeah, there you go, 2:30. So we will be tuning into Jerome Powell's live comments at 2:30 p.m. Eastern time. But let's see. This is a comparison of Wednesday's Federal Open Market Committee statement with the one issued after the Fed's previous policy meeting on December 14th. God, I can't even fucking read this. This is how you know you're getting old. Dr. Jennifer Berry, are you an eye doctor? Let me know if I need let me know where if you are an eye doctor, let me know where you're at, and I've never worn glasses before, but might be time for some. I always wonder what kind of doctor you were, Dr. Jennifer Berry. Recent indicators point to modest growth in spending, blah, blah, blah. Okay, inflation has eased somewhat, but remains elevated. Okay. So that is line number one, Russia war, which honestly doesn't mean anything for the market. Line number two that was changed. In addition, the committee will continue reducing its holdings of treasury securities and agency debt and agency mortgage-backed securities as described in its previous announcing plan. So QT, quantitative tightening, really that's all that there is. I don't know that this warranted an entire news release, but we will be hearing from the man himself, Papa J. Powell. All right, dude, happens to the best of us. Get some readers. Dr. Jennifer Berry, emergency medicine. Oh my God, your life must be interesting. You're an ER doc? Your life must be interesting. Well, if the reading situation gets too bad, I might have to visit the ER to get a prescription, if it's that bad. I'm just playing. Of course, market just goes straight up when I buy puts. Buying puts is not what you should be doing here. What you should be doing here is waiting for Jerome Powell to speak before doing anything. Because the biggest move will happen when Jerome Powell speaks. You just bought puts, my friend, and I've seen you post before, Nick Roy. You're buying the news. Why would you buy puts as soon as that is announced, right? Obviously, the market is going to flush your puts because the smart money did all this stuff before this happened and are now fading the puts or fading the bearish play, right? Learn to trade with liquidity. You see this here? This is the market taking out everybody's stop limits. This is what this big wick is here. This is a liquidity wick, right? So everyone that thought that they were going to play the news drop of the rate hikes are going to unfortunately get taken out, right? You set your plays in before it happens. Also, the biggest moves happen around 2:30 p.m. when Jerome Powell talks. Straddle. No, not straddle. If you're playing a straddle or a strangle on this day, you have to make sure that the market makes the expected move. If the market does not move in a crazy amount, your straddles and strangles are worthless. The market is not going to give you a free play. So please know what strategy works for what market environment. Now, if the market makes a huge move, so say the market rallies or tanks by 3 or 4%, then yeah, your straddles and strangles will make money. But if the market is like this, your straddles and strangles are going to get eaten up, and you will come out with nothing. So your best bet is to, if you wanted to play puts, your best bet is to play puts at the high of the day, which is happening now, before Jerome Powell speaks. Because when Jerome Powell speaks, if you're expecting him to be bearish, that is when you'll see the biggest move down. But you have to be, I'm talking about split second quick move. You can't just hold your position, right? All right. Like if you see this in the academy, our other analyst, Dr. Cortex, sent out an alert for SPY calls, and immediately those jumped over 10%, 15%, within a few seconds, right? Playing this move right here. So you have to be really quick with it. And if you're inexperienced, this is the time to paper trade. Get used to how these binary events play out, and that way you could be ready the next time. But if you're not experienced, you honestly cannot believe how fast these moves will happen today, especially if you're trading options. All right. Sonar, what's going on? Carvana squeezing. What about inverse iron condors? What is an inverse iron condor? Never heard of that. Somebody yesterday was telling me about they were doing straddles with spreads, which also doesn't exist. It's not an inverse iron condor. You're talking about a credit iron condor or a debit iron condor, right? So a short or long iron condor. If you're going short an iron condor, you want the price to stay in within a certain range. If you're going long an iron condor, it is like a straddle or a strangle, kind of, but you basically have this range in the middle where you don't want the price to be. All right, sorry if you covered this, but how does this play into the remaining big earnings this week? Let's say Apple smashes earnings, but Jay Powell gives bearish. Yeah, then the market is going to be, I think that the market is, so Sasha was asking if Jerome Powell gives a bearish talk, but Apple smashes earnings. It really depends on guidance. If Apple smashes guidance, not only earnings, but really if Apple smashes guidance, then you can expect there to be, I think, obviously volatility in the market, but if Apple, Amazon, and Alphabet smash guidance, then I think the market will be doing more of this, not believing Jerome Powell, honestly. If Apple just does it, but the other two don't, then I think the market will still potentially act in a bearish pattern if Jerome Powell is bearish, right? Or if he comes out hawkish. When is Papa Powell speaking? Henry, come on, man. Get with the program. Z not ready for the inverse iron condor. Isn't it just a condor? Guys, there's a short iron condor and a long iron condor. Okay? The short iron condor looks like this, right? Where you want the price to stay here in the middle and you make money. The long iron condor, which is a debit, looks like this, where you want the price to be outside of the middle. You want the price either here or here, okay? Why have markets fallen in the past after the pivot? Very good question, Richard Scott. The reason that markets have fallen in the past after a pivot is because the market only pivots when shit gets bad. That's why. The market doesn't pivot before price instability has been fixed. The market, the Fed doesn't pivot before price instability has been fixed. The Fed doesn't pivot before unemployment starts going up. Remember, the Fed wants unemployment at 4%. They've stated this. When I tweeted this before, people were like, "What do you mean? The Fed doesn't want unemployment to be 4%. Their mandate is max unemployment." Yes, max unemployment, not low unemployment. Meaning, what is the max unemployment that they can sustain while still keeping prices down? So right now their target is 4%. Unemployment is 3.5, the lowest since 1969. And we'll know on Friday what is the new number. But the Fed wants to see unemployment above 4%. They've stated as much. Wife heard this term as short iron condom. Well, I'm glad your wife is listening to this. She must either be very bored or very entertained. It's on one or two extremes. Man, I'm so disappointed. I wanted a 75 rate hike. Fury TV, do me a favor. Close your brokerage account, close your laptop, and go fishing. All right. Who in the right mind would have guessed a 75 basis? You're living in fantasy land. By the way, you're the second person that said this. 75 basis points. Like, honestly, everybody's become an economics expert, right? Everyone's become a Fed expert and an interest rate expert. 75 basis points? Come on, man. Come on. And by the way, honestly, like, I'm joking, but I do love the fact that, you know, this channel, you know, as well as just the general interest in the markets online, has really gotten people to tune into things such as CPI and FOMC. These are things that I used to nerd out on before it was even mainstream, right? And I'm so glad that people are actually watching this stuff more. But, you know, educate yourself a little bit better on that. 75 basis points, you're nuts, man. There's no way they could do that. People are laughing at 75 basis. Exhumed 616, bro. You're killing me. Medieval birth control. Because I said inverse iron condor, and somebody's wife thought I said inverse iron condom, and Exhumed said medieval birth control. Y'all are funny. Z, I net Jay is going to be super aggressive. He's always good for a rug pull every time he speaks. Sometimes, I mean, if you remember the November speech, he was all smiles, came out, you know, looked like he looked like he was glowing, dude. He looked like he was pregnant. Like the market rallied since then, right? The market has been only going up since October. But if you remember Jackson Hole, Jerome Powell, that was like fucking. You remember when Tupac was released from jail and he came out with that double album, All Eyes on Me, like right after jail, and it was his best work ever. That is the Jerome Powell that came out of Jackson Hole, right? And we need All Eyes on Me, Jerome Powell today. Z's like that guy who is, I listened to this song way before it was cool. Yeah, to be honest, looking at the CPI FOMC meetings now is like weather reports. Yeah. Last time he came out, he got schlopped. Jackson Hole, J Powell was different. Yeah. Yeah, classic album. McCann says, yeah. If you're old enough and you remember how angry Tupac was, like he got shot, right? Thought it was Biggie's crew. He went to jail on supposedly it was false pretenses, a false story that a female said that she was assaulted by him or whatever. So he felt like he was wrongfully jailed. He felt like Biggie's crew shot him up. And he came out of jail with All Eyes on Me. And it was that's when he first signed to Death Row, right? So Suge had bailed him out of jail. Like, that was Jackson Hole, J Powell. Dope ass Tupac reference, yeah. That double album changed the game. Yeah, you remember everyone came out with the double album. Then it was like E40 had a double album. Master P had a double album. Like, rappers that had no business making double albums were coming out with double albums, right? But really the only 3 double albums that I liked were Life After Death, All Eyes on Me, and maybe Speaker Box Love Below by Outkast. Oh no, Wu-Tang Forever too. 4 double albums. 4 double albums. All right. We are waiting for Mr. Powell. 7 minutes until prime time, folks. 7 minutes until prime time. We will get there, I promise. All right. Wow, really nice liquidity wick here. I wonder who was able to short this right here. This is why futures, honestly, on days like this, is superior to options, right? Because options, with futures, you don't get that fucked up pricing. Options are irregularly priced. Outkast double album was way after, though. Yes, Outkast double album, we had already hit the 2000s, for sure. It was like mid-2000s. Top 2 stocks to buy for tomorrow. Why are you buying stocks tomorrow? You should have bought stocks in October, November. Tupac's best was Machiavelli. I said up until that point, it was Tupac's best work. Master P had a double album. Yeah, he had a double album. It was horrible because he had that production crew called Beats by the Pound, and their beats were just terrible. Okay, I'm gonna give you a stock before J Powell comes on. Okay, look at this here. I sent this out yesterday in the Academy. Okay, JEPI, JEPI, JP Morgan Equity Premium Income ETF. Now, there's a reason that I love this ETF. So this ETF only contains S&P 500 stocks. So it's an S&P 500 based ETF. Somebody guess what the dividend yield is on this ETF, especially for those of you that really are into accruing or accumulating high dividend stocks, right? Because a lot of people, I see this online. I have no qualms with that strategy, but dividend investing is very popular online because people want to build a portfolio where, say, they're now making $4,000 a month just from dividends, right? Which is dope, But I think depending on which stocks you pick, you can get into a lot of trouble because what people don't understand is that dividends are not guaranteed. Guess what the dividend yield is on this? Yes, Richard has it right, 12%. So 12% on JEPI only contains S&P 500 stocks and is meant to be less volatile. It's a low volatility, high dividend ETF. It's meant to be less volatile than the S&P 500. So if you look at currently it's down 13% and the S&P 500 is down 15%. Now, what is the drawback? Obviously, because there has to be a drawback. The drawback is if the S&P 500 makes a violent move up, this will make a few percentage points less. But in uncertain times, if you're trying to get paid 12%, and by the way, the market averages 12% a year. So if you're trying to get paid 12% a year, a really sensible payout and one that is respectable, check out JEPI, and it's managed by one of the biggest banks, JP Morgan. It has a 0.35% expense ratio, so it's not expensive at all, and it pays a 12% dividend. And it's less volatile than the S&P 500. And if the S&P 500 if you don't know if this is the bottom or not, which nobody would know, and nobody could tell you, but you don't want to keep your money in cash and you want to invest, look at JEPI. 12% dividend yield. All right. So hopefully you learned something with this because a lot of people probably haven't heard about this. JEPQ is the QQQ version. Yes. But remember, the QQQ is a lot more volatile. So the reason that I like JEPI better is one, the dividend is higher while being spread out among a more diverse portfolio because the S&P 500 is way more diverse than the NASDAQ. The NASDAQ doesn't only contain tech stocks, which I've seen some dumb YouTubers quote, but like the NASDAQ still has stocks like Pepsi and whatnot in it, but it is more tech focused. So it is very, very tech heavy compared to the S&P 500. So the S&P 500 is more diverse and less volatile. Sure, if the NASDAQ is your thing, JEPQ is the way to go. For me, I would much rather put it in JEPI, but you know, do as your risk tolerance dictates. All right. It doesn't show anything on Robinhood. Yes, because you need to get off a shitty platform like Robinhood. There's no excuse. If you live in the US, get off of Robinhood. If you don't live in the US, get on Interactive Brokers. Robinhood you shouldn't be trading on Robinhood. There's really nothing useful you could do with Robinhood. Boyle? Yeah, that's a tough one. I mean, Boyle is an inverse leveraged ETF. Is it possible for you to take a look at Ford, sour avocado? Not unless you give me a more specific question. What platform do you use? Thinkorswim by TD Ameritrade. Thank you for the recommendation. I appreciate you. Watch all your vids on 1.5 speed. Listening to you in real time is crazy. Yeah, I must sound like Barry White to you. If you watch me on like chipmunk speed, 1.5, come on, bro. You're doing me a disservice. I must sound like fucking Alvin the Chipmunk on 1.5 speed. So right now I must sound like, you know, like Barry White. I'm like the stock Barry White right now. All right. Pow pow in the house. Let's see what's up. Why is the market not moving? Harsh it. Close your brokerage account. Stop trading. Stop trading. Okay? What do you mean why is the market not moving? Look, is Jerome Powell at the podium? Why is the market not moving? That's like going to a basketball game and they haven't started the game yet. And you're like, why are there no points on the board? Because the game hasn't fucking started. All right, let's see what's up.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex-housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
yes,
you're, okay.
Yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smilek from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the on the forecast, if you're right. If you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now. But that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven.
All right, I'm going to summarize what Jerome Powell said. I'm going to summarize what Jerome Powell said, and we're going to talk about this, and we're going to talk about the market's reaction in a second. I want to go over some of your trades because a lot of you caught calls on this, which is amazing. But yeah, I'm going to get some more coffee, and then we'll pause Jerome Powell, and I'll talk about it.
I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough, but I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit.
All right, I'm going to pause right there. Let's go to your questions. I saw a lot of you play calls. I'm really proud of you guys. Obviously, I was covering this stuff, so didn't get a chance to trade much. Obviously, the analysts in the academy are taking care of you guys, for those of you in the academy, but I like seeing you guys were playing calls, because I think too many people were playing puts here. Even though the market is meant to really draw as much liquidity from retail as possible, so there's still a chance that the market will tank on this, and we'll talk about Jerome Powell in a second. And his commentary in a second. But, as I said here, like, I think that people, not only new traders, by the way, unfortunately, you see this among even, I don't want to say experienced, but even people that have been tracking the markets in a casual manner for quite a while, that's, they thought that it was just automatic puts day, and that's just not the way that the market works, honestly. As I said, if you look on this day here, this was either FOMC or CPI. We broke out of this downtrend violently. There's no reason whatsoever why the market cannot take everyone's liquidity before heading back down. So let's talk about what Jerome Powell said in a second. By the way, congrats to those of you that were playing calls. And playing calls is not necessarily bullish, right? You're just playing the volatility. So even if you think that the market is going to tank after this, whether on earnings tomorrow or unemployment on Friday, it doesn't mean that you can't play calls today or go long futures or whatever. So here's what was surprising to me about Jerome Powell's comments is that he reiterated the 2% inflation goal. And the reason that's surprising is because, I've been hearing a lot of talk recently about the goal no longer being 2% and the goal being, somewhere in the range of, potentially 2 to 3% would be acceptable. But he maintained that 2% target. He said rate hikes are ongoing and insinuated, or at least implied, that there was going to be more than one or potentially more than one in the future. So didn't, really at that point initially in his speech, didn't obviously talk about pausing or slowing down. He talked about letting the balance sheet run off. He did mention that there was subdued spending, that the housing market was down, but jobs were definitely the focus. And he said the labor market continues to be very tight. We're at, the lowest unemployment in 50 years. So, all of that, I think, is pretty much in line with what we thought. He said, but he did say that we need more evidence on inflation decline, acknowledging that inflation can be sticky and that we need more evidence on the fact that inflation decline would be, would be something that's sustained as opposed to just registering a few months of inflation decline and then inflation ticking back up again. So there's that. You know, he did mention the financial conditions, but didn't really talk about the financial, because someone had asked him a question about the financial conditions, and he said, yeah, we take a look at everything, but didn't really harp on them, and then reiterated rate hikes. Now, I think where the market so far, and, you know, we still have an hour left until market close, but where the market so far is reacting to Jerome Powell positively is when he was asked about pausing. So he was asked about pausing rate hikes, and he, you know, he basically, and they asked him, you know, did you guys talk about pausing rate hikes? And he said, you know, you will see when the meeting minutes come out, we were discussing our path to the future. And then they asked him again about pausing, and he said the same thing. So there was almost an implication there that they did talk about pausing. He just couldn't say that in the meeting because he would sound way too dovish. So he was trying to dodge the question, like Neo in the Matrix. He tried to dodge it every time, but you could tell that they did talk about pausing in the meeting minutes, right? In the meeting itself, the FOMC meeting, which is a closed door meeting with just the Fed members and Fed presidents. So they did talk about pausing, it seems like, right? But he couldn't say it, but he implied that it was something that was discussed in the meeting. So I think that is really what the market is responding to favorably. Gamblers played calls, Sagar says. No, I think anyone playing today is gambling, really. You know, unless, you know, let me see, like, even if you took a look at, at the chart, you know, if I'm being honest, if I was trading this, maybe you would front run a liquidity grab here, right? Because if you guys follow this channel and you're part of the mastermind Zoom calls and you're part of the academy, we talk about this all the time, is that the market is just a series of looking for liquidity, right? So after taking out this liquidity here, you know, you could have front run this. I typically don't trade like this. So if I'm being honest, you know, if I was gambling, for sure, I might have went long on futures, and after this liquidity grab here, had set a stop limit below it. But, you know, typically I wait for retracements, and we didn't get any significant retracement. The only one that I would have traded was probably off of the 1 minute chart, if I'm being honest, was probably this retracement here, because we did retrace into this gap. Excuse me. Also, if you are a candlestick trader, this right here is called a 3-bar play, right? Where you have a green candle, you have a red candle with the body inside the green one, and then this impulsive green candle here, you would play that at the breakout, and then set your stop limit below the red candle, right? So if you were a candle trader, you have another one here, by the way. This is another 3-bar play on the 1 minute. So those are really the only ones that I would play. And then maybe, you know, a scalp off of here, not even a long-term hold, but just a scalp for a few percentage points off of there. So there were some opportunities if you were actively day trading this, but not a ton unless you front ran as a gamble this liquidity grab here. So hopefully that helps you looking at these charts in hindsight. All right. Any questions? Puts. I would not buy puts here, man. I think more is lost trying to counter trade a strong daily trend than not. You want to trade with the trend, not against the trend. Now, again, if you buy puts, you know, you could get lucky buying puts here. But I would not buy puts as a sort of a, what do you call it? As a sensible play, right? It's just a gamble. But for sure, you know, just as people who bought puts or shorted the market are getting spanked right now, the market can easily turn. Like, this can easily turn into a red day within the next hour. right? We've seen that happen. We saw that happen here. Like if you remember on this previous day, like we were up, the market was up 3.5% before dropping all the way down to it. It still eventually ended up green, but it was only green by like 0.7%. So we could see us losing all these gains here in preparation for earnings tomorrow. Nobody knows. But it definitely could happen. It definitely could happen. All right. Cool. So why would it go red though? I don't know what you mean. Why would it go red though? Why does any day go from green to red? It's just it's just volatility, right? It's such a volatile day that anything can happen. What do you mean? Why would it go red? It's just volatility. You're playing a binary event. Rob Atkins, 95% on calls. Thanks to the trading group. Love your trading Discord, Z. Appreciate you, Rob. Yeah, amazing. I'm glad that you took that trade. I personally wasn't in. Calls because I was on this call itself. But yeah, I'm glad that you took that trade. Gurinder, appreciate you. Appreciate you too, man. Any questions regarding FOMC or trades or charts? What are your thoughts on earnings? Which earnings? Gold. No, gold is a horrible trade. Loaded SOXS at 24, whatever, holding. Don't whatever trades. This is a triple leveraged inverse ETF. I would not load up and hold. These are meant for very short-term plays. What about Meta? Meta, you want to know who's reporting today? Let's see. This is who's reporting today. So we have Meta after the close. We also have, what are other big companies reporting today? Maybe McKesson. Those are really the only two big companies reporting today. Tomorrow is the day, right? So obviously we have the pharmaceuticals reporting pre-market. You have Lilly, Bristol Myers, Merck. And then after, we have major earnings. Three of the biggest companies to report: Amazon, Apple, Alphabet. Three of the biggest companies in the world, right? Then we also have Ford. We also have Qualcomm. This is a chip play. And then we also have Starbucks. So this right here is going to be huge tomorrow, right? If you guys want my opinion on this, I don't know. Who knows? I do think that Apple's guidance will come in muted. Amazon, I'm not sure because they're so multifaceted, right? You have the retail side of things, and then you also have the the Amazon Web Services, etc. So who knows? With Ford, I mean, GM reported decent earnings. I think Ford's guidance might not be that great. Maybe a little muted, maybe a little neutral as well. So we'll see. I'm not sure. It seems like 25 basis points was already priced in. Yeah, of course. Look at this. 99%. Of course it was priced in. Why do you think the market reacted positively? I just talked about this. I just went on about this for 20 minutes. Okay. Can someone check on Cassandra? Oh, you're talking about Michael Burry? I think Michael Burry was just responding to what's his face? To Kramer, because Kramer said the bull market had just started. Thank God I didn't make a move yet. Yeah, I mean, sitting out is probably the way to go here. Y'all gamblers and I'm salty. Well, if you didn't take the gamble, don't be salty. All right. Kramer nailed it. Guys, what? The market is not one day. The market is not one day, right? Like, I love how I just, this industry sometimes pisses me off so much because it's like, if you're talking about the market being bullish or bearish, people will wait for one day that counters what your long-term thesis is and be like, oh, see, XYZ, like you were wrong, or this person was right, or whatever. Like, it's so idiotic to talk about one day when you're referring to a long-term or midterm analysis, right? If Kramer says the bull market just started and you have one day that's up 0.9%, that doesn't make him right. It doesn't make him wrong. It doesn't make him right. It's just, you're talking about one trading day. It's 0.9%. Like, chill out. We could totally fall off a cliff in a day. Yeah. I mean, look, to be honest, like, I was so comfortable buying in October. And for those of you that are part of the academy, you know that. That is the last time I made a significant buy, apart from Tesla below 120. I sold some Tesla yesterday, to be honest, to capture some gains. But I was comfortable buying there. I'm not comfortable buying here because there's too much. Like, this is an epic rally, an epic bear market rally so far, right? People that are buying here are people that the institutions want them to buy here, right? I'm more comfortable buying when things are tanking, when the fear and greed index is at fear, when the VIX is higher. So, in this stage, the VIX was like at above 35. Everyone was talking about doom and gloom. I love buying during those opportunities. Like, it makes me more comfortable. Buying here does not make me comfortable. Now, if you look at a stock and you're like, oh, I think that it's decently priced, I'm going to buy here. Well, good for you. Good for you. But for me, that's not really for me. And if you guys want, hold on. This was my analysis on October 4th. Look at this. October 4th, 2022. I'm not going to read the whole thing, but I said, as I've stated before, it's a good time to sell cash secure puts and dollar cost average on blue chips if you have a long-term horizon. Many names that investors were praying for cheaper are at prices. Wait, for cheaper prices are at 30+% discounts. SPY, Triple Qs, Soxel, Microsoft, Google, Amazon, Nike, Disney, Nvidia, Tesla, Apple, XLE, Amazon. Because you never know when the bottom is, averaging into these names at major support levels and rare discounts is the way to go, especially in a bear market recession. Trying to time the bottom is useless, so erase that from your mind immediately. Instead, focus on the discount you're getting on a blue chip stock that you've been waiting to own. Don't let anybody ridicule you for accumulating in a bear market for the long term. The sheep pat themselves on the back for buying tops in a bull market. Buying at these levels is not obvious to most retail investors, so they resort to ridiculing or fear-mongering here, right? This was October 4th, 2022. Just so you don't think that I'm making this shit up. So I was super comfortable buying at these levels, right? And I accumulated a lot there. The only other ad along the way that I did was I bought XLE at some point, and XLU, which is the energy and utility section of the S&P 500. And then I bought Tesla below 120. But, it's people will wait for the highs to buy again. So Gun to your head, short or long Facebook into earnings. If you put a gun to my head, I'm going to smack the shit out of you. All right? That's what's going to happen. I personally, I think you have to take what the market is doing right now, right? I personally have a bearish outlook on Meta in general, right? Doesn't mean that on one day it can't rally. So if because of the market euphoria today, right? If Meta shows, hey, we stopped spending money on the metaverse, and we're putting that money, that 30-something billion that we spent before is now being put to good use. We're no longer spending money on the metaverse. Then I think Meta can keep rallying, right? It really depends on what they say on their guidance call. If they say we're spending more money on the metaverse and we have no cash left, then expect Meta to tank, right? Stop being a bear on Meta. Dude, I can be, whatever opinion I want to hold, I can hold, dude. Like, I personally don't believe in the metaverse. I just don't. I think that it is a very daring and desperate pivot from a company that is losing a ton of market share. I think that Meta's strong point is if TikTok gets banned, Instagram Reels is going to take over as the prevailing short form content platform in the US, right? So I actually think IG Reels is their biggest gold mine. I think the metaverse is bullshit, to be honest. Traveling trader. This guy said the market will tank today. What guy? Me? Show me where I said the market will tank today. Show me where I said that. This is what I tweeted. This is what I tweeted before the FOMC meeting, 3 hours before. Don't be surprised to see the market rally. Dumbass. People just want to say anything. People just want to say anything. Stop being a bear. Dude, if you show me that you bought in October, if you show me that you bought a bunch of stocks in October, I'll give you $1,000. Okay? I will wire you $1,000 if you show me that. If you show me your cost basis. I'm the last thing from a bear. I'm not a bull or a bear. If I see an opportunity, I'm going to take it. Right? This isn't like some cartoon where you have villains and good guys. Have you covered Tesla outlook already? Not yet. By the way, if you believe in the metaverse, why do you care about what I say? That's what I want to know. If you believe in the metaverse, go ahead. Put those stupid fucking goggles on. Walk around your house. See if your girlfriend or your wife still thinks that still finds you attractive. Go ahead. I mean, it's just my view on a shitty product. Like, that is my view. If you have a different view, awesome. Put your money where your mouth is. Chris Underwood, I don't know how you deal with this all the time. I'm glad Discord is not like this. I know, Chris. You know what I mean? Most people are cool. It's just, I think there are people that are searching for validation, so they try to project things onto you, right? because they want to appear right. What's your thoughts on Palantir? Shit company. If you like it, buy it. I think it's a shit company. Rob Atkins. Almost every call out in the Discord was calls today. There you go. Fury TV says the mierdaverse. Yeah, Palantir is shit. Yeah, I don't understand Palantir. You're right. I don't understand Palantir. Company's been around for 18 years, can barely turn a profit, and I don't understand Palantir. Bro, go ahead. Like, put your money there. Why are you worrying about me? Put your money there. Show me how rich you are. Put your money there. Show me the vacation that Palantir paid for. Show me. Hans Benz donated $20 St. Jude's. Appreciate you, man. Thank you so much. Thank you so much for keeping this chat positive. Rhonda Gordon, Team Z. All right. You should remove all the shit talkers. No, it's all part of the game, man. They just search for validation. Most people are cool as shit. It's like either they search for validation or, you know, it's people that are not really informed about the market, and that's fine. That's what we're here for. Thoughts on thoughts. All right. Thanks, Z. Are you still in the ZOM trade? How are you planning on playing? Let's take a look at ZOM. The one thing that I don't like about this, this play is still near break even, but the one thing that I don't like about it, honestly, is that now resistance is acting as support, and that's usually a bullish sign. So, you know, I might exit this position on ZOM, to be honest. Does selling cash secure puts midterm have any downside? Of course. What if you're, you know, I wouldn't sell cash secure puts here, right? Like, depends on what. Like, say, you know, Tesla's up, what, 80% in 3 weeks? Which is crazy. And for those of you calling me bears, yeah, I did say that Tesla would be a gift under 120, and I bought it under 120, which, what, does that make me a bull now because I bought Tesla? No, it's just my analysis and where I was comfortable buying Tesla. Tesla's up 80%, right, in 3 weeks. So if you sold cash secure puts here, you're in a dangerous spot. Because what if Tesla, you know, what if earnings on Amazon, Apple, and Google are not great? What if the market decides to interpret the Fed decision late? What if unemployment comes in still very low on Friday? And you see Tesla then dropping back down to the support level. Then you're going to be holding a bunch of Tesla stock, if you get assigned, for a lot higher than what the market is. So of course there's downside now, right? Like, you want to sell cash secure puts, not here. You want to sell cash secure puts on a downturn, right? Like, as it's tanking, you want to sell cash secure puts. You don't want to sell cash secure puts on the way up. Plus, you're not going to get paid for it. People don't seem to comprehend how hard trading is. Yeah, I know. They think because they can click buttons on their platform that it's easy. It's definitely very hard. Is it worthwhile to short Tesla? No, don't short momentum here, right? Tesla, if you look at this is just a classic bull flag here. And if you look at the broader pattern, this is the inverse head and shoulders. No, you don't want to short Tesla here randomly. Guys, let me tell you something. Trying to make money by going counter trade, you will lose a lot more doing that than trading with the trend. Okay, trading against the trend, you might hit it, luckily, a few times, but you will lose more than you gain trying to trade against the trend. You're much better off trying to trade with the trend. When are you wiring me the 1K? What are you talking about? Stop begging, bro. What are you talking about? What are your thoughts on CVS for a swing? Let's look at CVS. You know what? I mean, if you can stomach the earnings that are coming up next week, I haven't taken a look at this chart in depth, but I could see why you would ask this. You know, you could set a stop limit below here. You just have to watch out for earnings, you know, in case you see a gap down. But yeah, I mean, I don't know much about their financial profile, I'll be honest. So, you know, that aside, if you're talking about the chart, yeah, looks okay. I don't mind it for a swing, but just know that even if you set a stop limit here, for instance, I could see why you'd be asking that just based off of rudimentary technical analysis. If you set a stop limit here, if it does gap down, you know, pre-market or after hours, your stop is not going to protect you. So as long as you know that. Messi or Ronaldo, come on, man. Messi, of course. I know you love blue chips. Do you ever look for and invest in companies that could potentially be disruptive? No, I never do that. Honestly, like there's no incentive for me to do that. You can make much, you can make much more having a solid portfolio and then trading on the side. Nima, you are insufferable, dude. You are an insufferable character. Can you please take a look at ENPH's chart? Earnings coming up. ENPH is one of those stocks, end phase, that has acted like a 2020 stock pretty much for an entire year. It's still extremely overvalued, but it is a profitable company, right? Which has some sort of merit in today's market where valuations have to be proven, right? So it's not only a growth company that is struggling to turn a profit. I think it actually does turn a profit, even though its valuation is still insane. Again, I mean, for a swing, yeah, this chart looks okay as long as you can stomach what happens after earnings, to be honest. What's a chance we see the news? I don't know what that means. Am I missing something? Powell came out dovish. I went over in detail. Powell didn't come out bullish or hawkish or dovish. It was really very neutral. But I think where the market really started taking off was when he was asked about pausing, and he wouldn't answer the question, and he basically was dodging it and said, you know, that they have talked about the future in the meeting, in the closed door meeting. And then they asked him about pausing again. And he said, we have talked about the future in the meeting, and the meeting minutes will come out next month. And so I think the market interpreted that as, oh shit, they're talking about pausing. So he really wasn't hawkish or dovish, to be honest. He was neutral, but I think that the interpretation there was that they did actually talk about pausing. And I do think, I mean, as I said before, if you look at the Fed funds rate overlaid with the 2-year Treasury, I do think pausing is coming soon. The blue is the Fed funds rate, right? Look at this flat line here. Look at this flat line here. The Fed pauses when the 2-year Treasury starts, the 2-year Treasury rate starts threatening the Fed funds rate. That's when you get a pause, right? So I do think that now, if you look at it now, we are very close to pausing, in my view. If you look at where the 2-year Treasury is now in relation to the Fed funds rate, I don't think that they're going to pause. I think that they'll pause. They'll do a rate hike in March, depending on what unemployment looks like on Friday, and what the next CPI looks like in March. But they will do a pause in March. They will potentially do a rate hike in March. Actually, let's see what we can actually see what the current odds of this are. So what the market is expecting for March right now. Oh, wait a minute. Oh, this is still old. It's not taking into account today's rate hike. Yeah. Well, before today, the market was expecting a 25 basis point rate hike in March as well, right? Is this updated? This might be updated, actually. So 17% chance as of now that the Fed doesn't do anything. 82.5% chance that they raise 25 basis points in March. So, you know, I do think that they will raise in March and then they will pause. But when the meeting minutes come out next month, I think we will see another rally, because in there, based on how Jerome Powell was acting, I do think that there will be words of a hike. William Reed, I know you think that is the way to get your question answered, but actually it's not. So I'm not going to answer your question, and you're going in timeout. Sorry, I'm new here. What does pausing mean? Pausing means not raising rates, just keeping rates where they are at. Once they pause, do you think we will revisit lows? No. No, I think the market will keep going up. What is your thoughts on the continuation of the bull trend? I think this will continue if the earnings tomorrow are good, as I said before. I do think that 4,300 is a decent target range. All right. Gap up or down tomorrow? I don't think. I think we continue to go up until earnings are reported. Mariano, I'm going to be late to pick up the kids from school, but this is just so entertaining. I'm glad you think so. Do you think we're still due for a hard recession? I never said anything about a hard recession. I think we will definitely get a recession. Whether it will be broad-based or shallow, I don't think anybody knows. Rapping from Canada, Wagwan, what's going on? Hey, if you're in Toronto, let me know, how is the Caravana in Toronto? Is it lit? Is it worth visiting? I've been to Toronto many times. I haven't been to Caravana. Nima, you are insufferable, dude. You are insufferable. There. Took care of Nemo. Are we landing softly yet? Yeah, I mean, I think that's what the market is trading on. Mega squeeze today. Always have those calls on the side. Okay, rate hikes, blah, blah, blah. Okay, cool. All right, if there's no other questions, guys, I'm going to end the live stream here, and I'm going to continue. Oh, shit, I was going to say I'm going to continue trading for the next. There's only 20 minutes left in the market. I've spent it entirely with you. So I hope you guys appreciate it. But I appreciate you guys. Thank you guys so much for joining. Leave a like on the way out. And thank you guys, especially those who have donated to St. Jude's. Appreciate you guys.